Hi, and welcome to the latest monthly market update from Zurich Life. I'm Jacqueline. I'm joined today by our Head of Investment Solutions at Zurich, Ian Slattery. There's been a lot going on in the markets recently, and today we're going to be discussing what has happened up until Friday, the 11th of April, how this has affected different asset classes, and what this might mean for you as an investor. We'll also talk about Zurich Investments' outlook in the short term and our recent positioning. But I'm going to start with a few of the questions that have been asked of us quite frequently as fund managers in Zurich recently, based on the recent events. So it'll be almost a quick fire question round, Ian, if you're ready.
Yeah, looking forward to it, Jacqueline. Thanks.
Great. Okay, so the first thing is, what has happened to cause the current markets to fall at present?
Yeah, so on Wednesday, the 2nd of April, just post the close of markets in the US, we saw President Donald Trump on the so-called Liberation Day announce tariffs across countries across the globe. Um, what has hit markets in the immediacy after that was both the scale of the tariffs in terms of the actual percentage figures. They were larger than people thought, and also the formula behind the tariffs was a little bit unconventional. So that was a bit of a cause for concern for markets. And we saw large falls on the Thursday, the 3rd of April, Friday, the 4th of April, and indeed into Monday, the 7th of April. Lots then happened last week. For example, we saw the US market just avoid going into a bear market, which is a fall of more than 20%. We saw the best day for markets since the global financial crisis then on the Wednesday. We saw the dollar have its worst day since 2022 on the Thursday, and then we saw the US market close out its best week since 2023 on the Friday. So a lot of volatility, but all led by the Trump trade tariff announcement.
A lot happening in the market. So, do you
Yeah.
think that there will be any room for negotiation between the Trump administration and maybe individual countries?
Yes, we've seen a little bit of that already in the last number of days. That was what was behind some of the large upward movements on Wednesday of last week. But it's a very fluid situation. It's hard to know. It does look like he will begin negotiations with some friendly nations. They're his words, not ours. And that would be a positive. However, it is worth noting that it's a very binary-led outcome market at the moment. What I mean by that is the announcements from the Trump administration are moving markets quite strongly in the short term. So it's a lot. There's a lot happening, and it's a move away from fundamentals in the short term.
So, with investors, do you think they should be, if they come to you and say, "Should I switch to cash?" Would you, what would be your opinion on this, looking at de-risking until the volatility is over?
Yeah, so I think the short answer is for the majority of people, a switch out of their fund or their markets based fund is not the best option. The beauty of personalized financial advice is there are certain scenarios that people may look to de-risk, etc. But we would always say talk to your financial advisor or financial planner. They know you best in terms of your financial plan. But for the large majority of people, if your personal circumstances haven't changed in the last 2 weeks, there's no need for your fund choice to change either. And sticking with the plan that you've implemented is certainly the advice that we would say generally to those who are a little bit, understandably, a little bit worried at the moment.
Okay, and we often talk about not having a crystal ball, but this is a question that's been asked of us quite frequently also. Do you think that this volatility is short term, and how do you see the volatility continue to affect the markets?
Yeah, we don't have the proverbial crystal ball as you've already mentioned. But I think it's worth noting, and this is the view from Zurich, if we look at the underlying fundamentals of the economy, as we do through our active top-down investment process, if we look at particular metrics like inflation is broadly getting under control or under control in the developed markets. Employment data has been very strong. We see earnings for the Q1 end of Q1 earnings season coming through at the moment. Sentiment has certainly taken a hit in the short term, but there was some positivity around markets overall. So this is a big if. But the underlying fundamentals of the global economy and therefore the environment for risk assets was fairly okay prior to this period of uncertainty that we've seen since the start of April. So if we did see a resolution back to where we were a couple of weeks ago in terms of the trade policy from the US, there's certainly no big reason why markets couldn't move forward. However, that is certainly a big if at the moment.
And from a geographical perspective, so the US makes up 2/3 of the global stock market. What is the US market a good place to invest now, or what regions geographically are you seeing opportunities in at the moment?
Yeah, it's a great question because for us as an active investment manager, whilst we don't like volatility, it hurts us all. It does create opportunities in terms of volatility across markets. And you make a great point there as well, insofar as the dominance of the US equity market as part of the global stock market, and indeed the US dollar as a currency as well. And we've seen big moves in the US dollar as well as within equity markets. So I do think for the large majority of investors, multi-asset funds is the best place to be. And I mean by that is a fund that would invest in like equities and bonds and property and cash and alternatives. And within, say, an equity portfolio of a multi-asset fund, geographical diversification is very important as well. So it's a very big call not to be in the US at all. But as an active manager, we make those decisions on behalf of our customers and investors on a daily basis. So as I said, there's always going to be opportunities there. And invariably having some exposure and a decent amount of exposure to the US equity market over the long run is the best thing for investors as well.
Yeah, and there's a lot of different types of investors, and each situation is individual to that particular person. But to take to profile a couple of different types of investors. So say you have somebody who is able to invest for 5 or 7 years onwards, what would be the general advice for an investor with that sort of time frame?
Because we don't like it, as we said, but we can expect these sort of falls. We might talk about that a little bit more. We can expect these falls periodically from equity markets. That's why when you sit down with a financial advisor and go through your risk rating and your profiler and your plan, we talk about a 7 year plus sort of time frame, because time is a great asset for you as an investor to allow you to ride out some of these periods. So if you've gone through your plan with your financial advisor or financial broker, you've come up with your risk rating and things like that. Most people we tend to see in Zurich invest in multi-asset funds and commiserate or matching with your risk rating as well. And for most people who have that longer term time horizon, sticking with your fund choices we've already discussed is a good option at the moment.
And to flip that, if you have somebody who's retiring this year or maybe next year, what advice would you have for this client?
Yeah, so for somebody, the at retirement market, when somebody comes to retire and looks at all the options available, it certainly needs financial advice. There's a huge amount of intricacy and personalized nature, I suppose, at that stage. So it really does depend on the individual circumstances. If they were going to go something like an annuity, which gives you a guaranteed stable income, or someone who might be going for an approved retirement fund, which is the way I would describe that as continuing to invest, which means your time horizon pushes out a little bit as well. So there's lots of, and then there's a concept of being able to take some tax-free lump sum cash at retirement as well. But hopefully if you are 12, 18 months out from retirement, you've had a chat with somebody who's giving you a bit of an advice around it. And if not, there's nothing like what we've seen the last 2 weeks to give you a little bit of a nudge to get financial advice as you approach to retirement.
Exactly, that's a really good point. And what's happened in the last couple of weeks, the tariffs have been very topical. Do Zurich have an opinion on whether we think this event is a cyclical event or a structural event? Will it have a knock-on effect in Ireland, such as jobs or higher costs for products, etc.?
Yeah, I might just when you say the word structural and cyclical there, I'll bring up a very long-term chart, and what it's showing you is the average tariff that would have existed for well over the last 100 years, and you can see there's a fairly large tariffs in the US in the 1930s, and then when you see things like the World Trade Organization and increased globalization and increased collaboration between the likes of the EU and the US, you see this line move down, which means there's more free trade, and then the dotted line, we put the big upward move that's come out of this as well. So um, it certainly is a short-term event insofar as how impactful it can be. It's not led by the economic cycle or anything like that. So it's hard to see it as something that persists for a very, very long time. But as we've already discussed, it's been led by maybe non-economic reasons as well in terms of the actors involved.
And so on the back of this, one of the questions that we've been asked a lot over the last week is, do you think it's a good time to invest at present?
Yeah, I think so. I mean, we might just explain this particular chart in a moment, but just to maybe discuss the idea of where you could be as an investor. So if you have a plan to invest, you have say a lump sum on deposit, or you're looking to increase your pension contribution. As we've already said earlier, if your personal circumstances haven't changed, you should still go ahead with that, particularly with the long-term time horizon. It brings me on to this particular chart here. And as you well know, Jacqueline, I enjoy a complicated chart, but if you stick with me for a moment, what I'm showing you here is in the dark blue line on the left-hand side is over any 1 year rolling period, what would your return from equities be? So you could have had as good a year as plus 61%, however, as bad a year as minus 43%. The same for the beige line, which is bonds, and then the lighter blue is just an illustrative 50-50 portfolio. But I won't bring you through every line, you'll be pleased to hear. But if we move from the left to the right, just notice the two things that happen as investors. Firstly, that range of returns narrows, and it also skews upwards. So the two things that history tells us from this particular chart is the longer you invest, the more certainty you have in returns, and more likely those returns are to be positive. So the point of entry in terms of any particular day, week, or month fades into insignificance when you look at these sort of longer term timeframes, which applies to most people, particularly pension investors.
It's certainly a really interesting chart, and there's lots of really interesting statistics behind the of having time on your side when investing. So I would like to emphasize the importance of staying informed and being adaptable. So the investment landscape is constantly evolving, and that has been particularly evident over the last few days, last few weeks. And those who are proactive in learning and adjusting their strategies are typically well positioned for success. So when you invest with Zurich, we have an expert team in the dealing room based here in Blackrock in Dublin, and they're actively managing funds in respect to market developments. So Ian, can you talk a little bit about Zurich's current positioning and asset allocation?
Yeah, so as we are here, as we talking to the end of the second week in April, we have made a number of decisions and changed our positioning since the tariff news broke on the 2nd of April. So as we stand here today, we are neutrally allocated towards equities, so at the midpoint of equity ranges. We've allocated a little bit more into cash in the last little while, and that's more a tactical basis as well, just as we go through this period of volatility. And then within the likes of alternatives, we maintain a material allocation to gold. So gold has been a strong performer over not just the last number of weeks, but the last number of years. And I might just share our investment chart of the month, which many people may have seen in our literature and online. And it just brings to life a little bit of the benefits of diversification as I went through those different asset classes within a multi-asset fund. So we have gold versus equity markets. And look, this is only up to a week or two ago to the end of March, and it's even accentuated further. But you can see just a clear difference that the idea of gold being in very clearly in positive territory, while equity markets were down at the end of March and are down a bit further as well. But a big spread between different asset classes. And that just really brings to life the concept of diversification, not having all your eggs in one basket, spreading your risk across different asset classes that will do different things in different times.
Yeah, it really showcases how gold can be a valuable addition to an investment portfolio. It can be seen as a hedge against inflation, a safe haven during market volatility, or just simply a way to diversify your portfolio. So moving to a segment where we talk a little bit more generally about investing. So I'd like to break down some of the common terminology that we might come across in the investment landscape, making it easier for both new and seasoned investors to navigate the financial markets. So this month we're shining a spotlight on the principles of long-term investment. So we speak a lot about the benefits of investing over a longer time frame, and you have some interesting data and statistics behind that, and it would be great if you could go through some of that with us now.
Yeah, I won't keep people here all day, so I'll just give a little bit of a flavor of it. But you mentioned our principles of long-term investment or investing. We've done a lot of work in this in terms of the team internally. So please do get in touch. Have a look at our website. We have the chart I'm showing you here and I'm about to explain. We have loads of slide decks, loads of collateral. So doing our best, hopefully, to help educate people. What I'm showing you here is the European equity market since 1980, and there's two data points for each year on the chart, right? So in the blue bar charts is showing you the calendar year return in each year since 1980, whilst the red dot shows you the peak to trough of that same calendar year. So if you bought in at the highest high and you sold out at the lowest low, made the worst investment decision in that calendar year. Now, European equities haven't been the strongest market over the last 40 years, 45 years, nor have they been the worst markets so far in 2025. So they're not a bad analogy to use. But just a couple of things to notice here is that the red dot is always going to be lower than the blue bar, which shows that if you stick with the plan even over the short term, it tends to be a good idea. But also just look at the average of the red dots. And if I focus in on the right-hand side, and we have this chart up to last week, the peak to trough for European equities in 2025 is minus 13%. That's what you would have lost. And if you just even eyeball all the red dots going back, all 45 of them, it's roughly on the average amount. So I think that's a very instructive thing for people to take away in terms of a principle of long-term investment. Whilst we have seen large, sharp falls, and in a couple of days they really do hurt, it's pretty much the average fall we can expect in any one calendar year going through history. So that little bit of perspective, taking that kind of long-term, wider lens, can be useful. So just a flavor of some of the collateral we have in terms of long-term principles of investing. And as I said, there's lots more available there as well.
That's really interesting. Thank you. So while periods of heightened volatility are not always welcome, they do serve to teach us lessons and to look at the historical patterns that we've seen and how we can achieve our financial goals based on the lessons from history. So that will bring us to the end of this podcast episode. Thanks, Ian, for joining me today, and thanks everyone for listening. I hope you found this update insightful. As Ian has mentioned, there is a range of commentary and updates available on our website. So for more information on the Zurich fund range and to catch up with the latest investment news, visit zurich.ie. And as we've spoken about a lot today, speaking to your financial advisor, your financial planner, and making a plan and then sticking to that plan is really beneficial for you to help you achieve your financial goals.